In this question, you are being asked to decide whether the following material events that have occurred after the reporting date and before the financial statements are approved are adjusting events. In order to answer this question correctly, you will need to draw your knowledge from the accounting standard IAS 10, which looks at events after the reporting period. This standard gives us advice on whether something should be adjusting or non-adjusting. For an item to be adjusting, it should be material and the condition should have existed at the reporting date. For an item to be non-adjusting, again it should be material, but this relates to events where the condition did not exist at the reporting date. We need to identify whether they are adjusting events, and so we are looking for evidence of whether the condition existed at the reporting date. Looking at these events individually, the first one is where there is a valuation of property and there's providing evidence of impairment in value at the reporting date. We can see that there is evidence that this was at the reporting date, and so yes, it should be an adjusting event. The next statement says that a sale of inventory held at the reporting date is for less than cost. Inventory should be valued at the lower of cost and net realizable value, and so if we have got a sale of inventory that's less than cost, that would suggest the inventory is overstated and should be an adjusting event. The next statement says that there was a discovery of fraud or error affecting the financial statements. If there has been an impact on the financial statements, then the condition must have existed at the reporting date and so should be adjusting. Finally, there was the insolvency of a customer with a debt owing at the reporting date which is still outstanding. If the balance was owed at the reporting date and they are unable to pay, to leave that balance in the financial statements would mean that the receivables balance is overstated. The receivables balance should be adjusted to remove the debt that cannot be paid. The condition existed at the reporting date, and so we have an adjusting event. Therefore, all four statements are adjusting events in accordance with IAS 10.